Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Desk Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch.
Markets have continued to be very volatile, even as we've moved past the recent meetings from the Fed, the ECB, and Bank of England. And of course, this hasn't been helped by the geopolitical tensions, specifically the situation surrounding the Ukraine. Listeners will recall that a few weeks ago, we had Alvaro Vivanco on, who said that mid-February was seen as many as the most likely timing for any potential move by Putin. And we're certainly in the heart of that. So while Putin has not necessarily taken any overt action against Ukraine yet, tensions do remain high. The situation's inherently unpredictable. So we remain watchful along with the rest of you as to if the situation deteriorates or if a peaceful solution can cool tensions. To be honest, I'm a little bit suspicious that Putin will take just a few minor concessions from the West, which is really all they're offering at this point, at least from his perspective, and just go ahead and turn away. But as we watch, the Ukraine situation has caused some good old-fashioned flight to quality of late, which has helped stop the recent push higher in global bond yields that has been dominant in the markets lately. Risk assets, however, continue to be buffeted, and 2022 is proceeded with challenge after challenge for risk assets. I mean, first, we had the expectations of higher central bank policy rates given high inflation start off January. Then some mixed earnings in January, followed by the ECB guidance signaling that they might even move towards tighter policy or certainly NQE faster than initially expected, which led to some fragmentation, meaning that European peripherals and European corporate bonds came under some pressure, as well as just generally the assets of peripheral nations, including their equity markets. And now they're being hit by escalating Ukrainian tensions. To be honest, one could actually argue that risk assets have held up reasonably well, given that quite substantive list. But soon they might face the original challenge once again, which is for the potential for even higher policy rates going forward, or for markets to start becoming even more concerned about that. This is similar to the January market rethink that started all the turbulence in the first place. And by this, I mean, and I want to focus primarily on the Fed, because again, that's what led things off in January. And speculation has certainly risen as to whether the Fed could actually start with a 50 basis point rate hike and get the whole ball rolling again and put potentially more increase on fixed income assets. So here I want to ask Kevin Cummins, NatWest Chief U.S. Economist, just one simple question. Kev, is the Fed going to go 50 in March like many are now speculating?
It's certainly a possibility, but I think right now, based on what we know, whether you look at the FOMC minutes or if you listen to most Fed officials, I don't think it's their base case. The meeting still isn't for another 4 weeks and a lot can change. But I think right now, based on what we know, the Fed's base case is a 25 basis point rate hike. It's going to come down to the data. They will have another CPI report to kind of hang their hat on. In addition, they'll have the jobs report for February. We're looking for pretty solid growth in both of those reports. But on the inflation side, we do expect a little bit of moderation at the core. Now, even if our forecast for core CPI, which we're expecting a 0.4% gain on the month, comes in, the year on year will continue to tick higher because of base effects. So we do think that, it will put some additional pressure on the Fed. Despite a little bit softer than what we saw in the January report. But by indications yesterday, for example, if you look at the minutes, the Fed could have, changed the tone a little bit more hawkish in that direction. Presumably their MO since that meeting is probably a little bit more pressure on the Fed to act aggressively. But you still had Fed officials, like, for example, yesterday, we heard from the Richmond Fed president, and he tends to be a little bit more on the hawkish side, and he still said his base case was 25 basis points. So I don't think that they've radically changed their views just yet, but the data over the course of the next few weeks could ultimately decide the eventual outcome of that. But I think right now, I think I'm pretty comfortable with our view that the Fed's going to go 25.
All right. And then, if they do, that would certainly, hopefully, maybe bring some peace to these fixed income markets, in addition to hopefully looking for peace in the Ukraine. I also have with us today Brian Daingerfield, NatWest co-head of G10FX strategy. So Brian, given what Kevin just said, and also thinking about how the dollar has benefited off and on, but of late, perhaps for some safe haven status given the tensions in Ukraine and in Europe. What does this all mean for the dollar? How is it going to be impacted between thinking that both Ukraine and then perhaps now and into a meeting if they could only go 25?
Well, great. Thank you very much for having me, John. The simple answer on the Fed is a 25 basis point hike in March at this point would probably be seen as a dovish disappointment. Right now the market's priced a little bit under 50% that the Fed would go 50 basis points instead of 25 basis points. And so that expectation would likely have to come out of the market. Then guidance is going to be very important coming out of the Fed meeting in March. If the Fed goes 25 basis points, that might set the market's baseline expectation that 25 basis points will be the likely size of future moves. So that could also bring down expectations as well, that the argument to go 50 basis points would mean you need to have even stronger data than you have right now. And frankly, the data that we've gotten recently in the US has been incredibly strong, whether it be the non-farm payroll number, retail sales and CPI, all of that made even more impressive by the expected impact from Omicron, perhaps not being as severe as we had felt. And so not only does it matter what the Fed does in March, it also matters what the guidance is. Certainly, I don't think the Fed would rule out the possibility of larger moves later in the cycle. We know there is some history of the Fed starting with lighter moves and then moving a bit more aggressively later in the cycle. We saw that in the early 2000s, for example. But there is the market's expectations and how the guidance relates to what the Fed does in March is going to be very important. Now, John, one of the things you mentioned, taking a look at the broader dollar, is that risk assets have held in relatively well throughout this period of volatility. And the inverse of that is that the dollar has underwhelmed relative to risk assets in a period where the data, the moves from the Fed, and frankly, some of the risks around Ukraine are probably all pushing in the direction of a stronger dollar. Instead, the dollar has really been treading water a little bit here, and it's weakened against some emerging markets, particularly some emerging markets where interest rates are quite high. Two things I think we can point to as why this might be the case. The first one is perhaps narrative fatigue, that simply the market is no longer seeing the stronger data as pricing in additional risk of much more aggressive Fed. Essentially, that's the fancy way of saying the Fed is what we call perfectly priced, that each incremental move higher in Fed expectations is no longer providing the same level of upside for the dollar simply because that story is already in the price. One thing I would point to, and I know this is a point that our US rates colleagues have made as well, is that the near-term expectations for the Fed, which are obviously going to be very influenced by 25 or 50, those have there's certainly a lot priced in for the Fed in the near term, but the overall cycle is actually still relatively low compared to what we're pricing in the near term. So for example, we're pricing in the end of the Fed's tightening cycle, the market, I should say, is pricing the end of the Fed's tightening cycle well below the Fed's own neutral rate estimate. So we're talking about 50 basis points possibility in March, but at the same time, the market's not pricing even a return to the neutral rate. So there's a bit of a difference here where the market's thinking the Fed's possibly going to be ultra hawkish near term, but that's not going to extend later, even though the growth data are probably going to continue to be strong. So there's still the possibility that hawkish Fed moves could strengthen the dollar if we see a reassessment of the later points of the tightening cycle. The second factor, I think, is positioning fatigue, where a combination of, we certainly have had a strong dollar over the past 6 months, sort of as a general point. And we know US equities have generally outperformed global equities over that period. And so that combination may mean that even though short-term speculative positioning data, stuff from the CFTC, for example, doesn't really suggest that dollar positioning is ultra stretched to the long side, the fact that you've had very strong moves in US equities overall likely means that dollar denominated asset positioning is probably still long. And so that might also be behind the reason why the dollar has not performed as well, that simply markets already have that on. And so the positioning, the impulse from new positions is going to be more difficult to drive the dollar higher versus push it lower, simply because that's the baseline position that the market has on at the moment.
All right, thanks, Brian. Thanks both of you for joining us. In addition to geopolitics, in the coming week, I'm watching global PMI data, European CPI is the main data points, and as always, the myriad of central bank speakers that are on the calendar. So in particular, and we didn't really talk about the UK too much in this, but there are some speculation out there as well that the Bank of England could be starting with a 50, although as Brian noted, the markets don't have the Fed going as high as even the Fed's long-term neutral. In the UK, they have policy rates actually falling in the several out years, almost in a policy mistake type stance. So with next week's testimony from Bank of England's Bailey and a few others to the Treasury Select Committee, how they talk about not just near-term policy, but long-term policy can certainly move things both on the rate front and the currency front. So, away from the data on Ukraine, that I think particular is going to be pretty interesting because as we know, even though we talk about the Fed this year driving a lot of the moves, it was the Bank of England kind of shifting things into the end of last year that really got the ball rolling. So that's what we're going to keep an eye on for. And good luck out there. Have a great week, everyone. Thank you.
I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.